Good afternoon, everyone. My name is Susanne Burstein. I'm a partner in the Maritime and Transportation Group at Seward and Kissel. This is the non-traditional debt capital panel. I am very lucky to be joined today by Cullen Schaar from Goldfish Capital, Jason Braunstein from Hudson Structured Capital Management, and Nikola Simic from the Carlyle Group. I'm going to let each of our panelists introduce themselves and their organizations further.
Great. Good afternoon, everybody. My name is Cullen Schaar. Been in the maritime space for a long time by virtue of being a Jefferies alum. So good to see a bunch of people here today. Started Goldfish Capital about 3 years ago to address a very specific problem I saw when working on the Taylor Maritime Grindrod merger. And Grindrod carried a lot more working capital than a TC out business at Taylor Maritime. So my partner in Athens, Stefanos Michaelis, and I created a product to finance individual voyages for ship operators, primarily active in the dry bulk space, but also entering into project cargoes and tankers as well.
Hello, everyone. I'm Jason Braunstein. I'm the Co-Chief Investment Officer of Hudson Northern Shipping Funds. We're a private credit strategy that invests in loans and leases to the commodity shipping industry. We started that strategy about 16 years ago, and we're currently on our 5th fund.
Good afternoon. My name is Nikola Simic, and I'm part of Carlyle Infrastructure Credit team. Carlyle, as you may be aware, is a large private equity firm, and by virtue, over the last 5 years, we have grown the credit business from about $30 billion to what's today over $200 billion in third-party commitments. So massive growth on the private credit side. A lot of that growth has been obviously flowing into the infrastructure development, infrastructure side of the business. So my focus across the board is in 2 different pillars of infrastructure. One of them is obviously maritime space, and maritime space has been a very busy space for us over the last 36 months, I would say. And based on the discussions I've heard so far, it looks very promising for incoming months as well.
Thank you. So we can start with a general question for all of you. As this is a non-traditional debt capital panel, can you please tell us what non-traditional debt means to each of you in the context of maritime finance and what it means to each of your investment firms? Is non-traditional debt capital and maritime finance becoming a misnomer as it continues to be a bigger piece of the equation? Who wants to start?
So, we all know prior to 2008, European banks dominated ship finance for like the last 150 years before that. Other forms of capital that have come in, non-bank lending, some iteration of what all of us do has grown significantly. Sort of non-bank lending or other forms of capital have gone from like less than 10% of the market 10 years ago to about 50% of the market in 2024. So this panel used to be called alternative credit. Clearly, we're not alternative anymore, but maybe we have another 100 years to go before we're not traditional.
Just echoing the same as previously mentioned, our focus historically has been in infrastructure, so we're maybe less of a ship financing institution, but more so what we call fancy now. The fancy term we use is floating infrastructure. So it really refers to essentially assets that either have medium to long-term contracts, whether they are bareboat charter contracts or time charter contracts. But essentially, there's underpin either monopolistic cash flow attached to a specific pool of assets or contracted assets or really, advantage that they have, not necessarily taking the spot market. So from our perspective, when we think about the universe in which a lot of the maritime space is financed, the difference we bring to the table is a lot of the times longer term and patient capital. That could mean going anywhere between 15, 20, 30 years, depending on the underlying cash flows and useful life of the project on one side. But then the other side is also layering in mezzanine and preferred equity like instruments that enhance the returns for the owners or potentially open up capital for them to grow the business or weather the storm. No pun intended.
we do things that banks can't or won't. In our businesses, we do both of those things. I think, from our perspective, we were trying to address a practical issue. So I don't know that we don't think about ourselves sort of, replacing banks in a product, because the banks don't offer what we do. And there's good and bad reasons banks don't do what we do. That's my answer.
Jason, you are fresh off of closing the Hudson Northern Shipping Fund 5, which at total commitments of $719 million exceeded your $700 million target. Congratulations on that. Can you tell us a little bit about that fund and what you think drove such high investor demand?
Yeah, sure. Thanks. So middle market private credit in the U.S. has grown exponentially since the financial crisis, but it's also become really commoditized. So there's these really large private credit funds, and they're all investing in the same or very similar broadly syndicated loans. So for investors, you can't just go to 2 or 3 or 4 different managers and actually get diversification. So investors are starting to get concerned about their correlation, some cracks showing up in the private credit markets, and they're looking for more niche strategies that can provide some type of real diversification. Asset-based lending certainly has caught that tailwind, so that's driven a fair amount of demand. And then for our fundraise, we raised about half of our capital from the pension fund market, and half from insurance companies. So we were able to get a rating on our theoretical portfolio from a major rating agency, and structure a feeder fund in a way that's friendly to the regulatory capital treatment of life insurance companies. So Hudson's sort of at that intersection of trends, both in private credit and the life insurance industry, which has really grown substantially through record annuity sales with high rates and as a retirement product. And so basically the takeaway for this audience is we have really good access to capital, and we're here to use it to support ship owners in the sale and purchase of ships.
Great, thank you. Cullen, turning to you. Goldfish Capital funds ship operators with secured revolving credit facilities and uncommitted money market lines to finance voyages for dry bulk tanker and LPG sectors. I know you have almost 20 years of experience investing in the maritime space. So as this panel description suggested, did you believe that was the missing link or a missing link?
Yes. Again, I think it was a bit reactionary as opposed to had some brilliant scheme. And it was fortuitous as we were looking at Grindrod, and they carried $30 million more working capital than we thought they would need to as they transitioned to sort of a TC out model under the Taylor merger, and happened to get a phone call from a friend in Athens who had an operator client who had fixed a cargo for the now defunct USAID. So it was food aid. It was U.S. government paper. And there was an opportunity to take 45 days of risk and make 3% in 45 days. So we tried to figure it out. I called some of your former colleagues and said, how do I attach a proper security package to this contract? And we've sort of just grown from there by word of mouth. And I think it just speaks to maybe a trend we see, speaking to the private credit markets. I mean, we've seen for 30, 40 years, credit markets have said, own assets, lever them up, fix them out. Don't do any work. Well, at some point, someone has to pick something up and move it from A to B. And those people typically aren't rich people. They hard workers at a trading house. They try to strike out on their own, and they live off that business. They don't have audits, so regulated bank can't lend to them. They cannot take that collateral as secured loan because there's deferred revenue liabilities. And so you have these guys who, they've got a good niche business. They've got the capital from their friends to handle 2-3 ships at a time. But oh my God, there's a $200,000 bill over there. If I just had $2 million to go pick it up. And that's where we step in, is sort of that incremental, growth capital. And we're effectively replacing equity, right? Because there's not an alternative in the lending markets. So it's very much a missing link for the people who move the things from A to B. Maybe not missing for these guys don't like it because there's security getting ahead of their the revenue ultimately making it to the asset. But I kind of like the idea of financing the revenue versus the earnings that come through these pieces of steel.
And just sticking with you for a minute, is there certain criteria that you look at to evaluate where to put your capital?
Yeah, sure. I mean, luckily all the really smart people have built all these software platforms where you can pretty efficiently monitor and score the risk in a certain voyage pretty quickly. And we score the asset, the ownership chain, the trading history, the sanctions risk, all these things come through. We've got discretion over the trade. And so, we want to be doing trades with operators with real businesses. I don't want them just calling a desk and saying, "Hey, do you have a cargo?" No, we want deep integrated people in a specific niche, and we want high quality paper on the shipper themselves. So we've done lots of transactions with all the big trading houses, very large investment grade corporates, and we effectively work our way into their payment streams. And so that's where we're trying to get deeply seated into that.
Nikola, moving over to you. You sit in infrastructure credit, and I understand that you work on a global business platform looking for investment across geographies and sectors. What kind of investments does Carlyle look for in the maritime space, and is there an interest in the niches within the maritime space?
Good question. So infrastructure is broadly defined for us. So the previous panel was talking about the opportunities or lack of in offshore wind. But, one of the questions I was going to ask is related to the rocket launching business or the volumes that are taking off and kind of how is that impacting the need for the vessels. But discussion aside, when we think about the world in the infrastructure space, we look at digital infrastructure being the key driver of the growth currently across all industries, followed by energy industry. And energy industry in this part of the percentage of our book is approximately 30 to 40%, which correlates highly to the maritime industry. So maritime and energy are really the crossroads of our appetite when it comes to investments in ship owners or are really providing credit facilities to the maritime sector. So, if I look at the current exposure across everything we have done, we financed rigs, contracted with large majors, we contracted drill ships, we financed FPSOs, FSRUs, really heavy energy assets that ultimately have long-term contracts. In the past, we also provided financing for LNG carrier vessels that had short to medium-term contracts. Some of those structures tend to be at the senior secured level. Some of those tend to be at a subordinated, kind of monetizing the dividend flow. So it's a little bit of, I would say, everything. We haven't been successful in identifying cargo ship financing yet, but that's something that obviously we'll be open to as long as the certain characteristics are met.
And just along those lines, staying with you for a minute, we know Carlyle has a very stringent approach to due diligence and credit selection. Are there certain common denominators that get a deal across the line?
Yeah, I mean, obviously, track record. Normally, it's a track record team. Obviously, the management of the company and the robustness of the contracts are really the monopolistic position. One thing is what we look for and focus on is understanding the fundamentals of the business and how capable the business and the management are, and how much of the proven track record they have managing difficult situations in difficult times. That generally tends to be the key aspect across all of the investments and sectors that we transact in.
Okay, thank you. This is a question for all of you, but Jason, I'll start with you. What do each of your organizations offer to customers and prospective customers as compared to banks and other sources of capital?
Yeah. We're doing asset-based finance in the commodity shipping industries, right? So as opposed to traditional capital, what we can offer is speed and predictability of execution. So the typical deal is we're talking to an owner, they find a ship that they agree to buy, sign our term sheet, and then by the time they put down their deposit, like a week later, they have the full commitment that they'll have the capital to take delivery. In addition to that, we're usually underwriting the vessels at higher LTVs with longer repayment profiles, so more capital and lower break even. We're counter-cyclical. So right now, we've heard a lot today about the banks being active and not finding deals. But at the bottom of the cycle, banks are nowhere to be seen. So we're actually pulling back a little bit now in terms of LTV. But at the bottom of the cycle, we'll be financing 85%. And lastly, we really understand shipping. We're a team of people that all we've done our entire careers is shipping, everything from the financing side, the commercial side, technical. We have 3 naval architects internally. And so, we understand as shipping goes through the cycle, how to help ship owners get through it. And as a result, we've never had to arrest a vessel, and we've been able to support ship owners all the way through.
Cullen, you want to go next?
Yeah, sure. Look, I think what we try to be is constructive for people who do not get any support from a leverage perspective. And these are risky businesses, right? A couple bad trades and an operator just disappears. And so you have to be very quick. You have to be very honest. You have to make decisions very quickly because these are guys in a dynamic, trading environment. And I think that speed, the experience on our team from an operating perspective, the ability to get direct answers is very differentiated in a way that, a depository just cannot be. And with a product that a credit fund cannot do because we don't have duration, we can't afford to charge 2 and 20 on a revolving line. So, we're permanently capitalized. So we're all equity, and we have to earn that return. So I think it's the right capital, financing that risk and matching it, and it's in this funky little niche is just too small for a depository or an institution to play.
Thank you, Nikola.
Yeah, I'll just compliment. I think to add one or a couple more things on our side, size. I think when we think about average investment or sweet spot from our perspective, that's a couple $100 million per opportunity. Think about it, $300-400 million being the sweet spot, and then going all the way up to $700 million per transaction. So when you have a need that requires a quick response and a reliable partner with a large investment, that's I would say a lot of the times the key differentiator. We have gone through situations, as I explained before, where we worked with sponsors and ship owners who had a 144A bond outstanding, and they needed certainty they will be able to refinance that, and we gave them a commitment to draw on that facility 6 months later. And as the bond was maturing, they were able to draw $400 million. And that obviously worked out really well, and that's what sponsors value. We own the paper, so part of the investment stays with each of the employees, which means that we're vested in the project and we're vested in seeing the company succeed.
Thank you. Now, this has been a question that's asked across panels and conferences for some time now, but it seems like we need to continue to ask it. How is the geopolitical landscape and uncertainty affecting your business? How do you position yourself in these times of uncertainty? Are you full steam ahead, willing to lean into the current environment? Or is it a good time to sit back and watch what unfolds while maintaining optionality?
Sure. So I think, it affects the day-to-day, of course, a little bit. We have to do more sanctions checking and making sure that ships have war risk insurance, all those types of things. But I think the biggest focus for us is that, the underlying demand growth in most of the core sectors that we focus on, the sort of true demand growth has been fairly nominal. What's been driving the markets to such peaks is all different forms of inefficiency. We had COVID and then sanctions on Russia and the situation in the Red Sea. So all these different things that are propping up the shipping industry, and eventually these things are going to normalize. So I think that's sort of our core focus, is making sure that we remain disciplined, and as markets normalize, we're prepared to weather the storm.
I would echo that. I think we obviously see a lot of opportunities, but at the same time, over the last, I would say, 12 to 18 months, we have seen divergence between companies that have been through challenging times previously and are probably more conservative this time around, sitting on decent piles of cash, to put it that lightly. And then you have newer entrants that are really trying to prove the market share and levering in excess. So we are obviously exploring and exercising higher degree of caution. I think we live in a opportunity-rich environment currently, but there seems to be also plenty of capital that is chasing those opportunities. So I think being disciplined is key for the next foreseeable future.
Cullen, anything to add?
We're too small to have an informed opinion. I would add, though, through the lens of the oil and gas space, we've seen a humongous change. Through the oil and gas business I work with, we own a very large piece of a very large Haynesville shale gas operator, which ties in a bunch of the LNG conversations. But that buyer and investor universe has changed profoundly in the last 24 months, with a lot of geopolitically motivated capital moving into the United States. So to the extent it affects people in this room, that has made a huge change in the last 12 months. The people that are making the phone calls, knocking on our doors. So Goldfish, we're too small. But it's been a major, major trend in what's going on in energy markets here.
Interesting. Thank you. So we have only like a minute left. I'm just going to ask each of you what you see as the biggest opportunities and biggest challenges in the coming years. Cullen, I'll start with you since you're close.
Our opportunity is twofold. Number one, to grow our book outside of dry bulk, where we started. We're working with two sort of project cargo heavy lift type operators where we like the specificity of, I call them the hostage on the boat, to make sure we get paid. We like that those customers need that specific delivery to happen. So that, and then also expanding into other realms of, call it maritime accounts receivable, insurance claims, demurrage, things that where banks sort of look sideways at that collateral, but there's real value there, and how to unlock that for operators.
I think the biggest challenge is what we just talked about, just the geopolitical landscape, and that values right now are very expensive. But the biggest opportunity, I think, is still the transition in credit from the traditional capital sources to non-bank lending. And it's really interesting that we have this panel with 3 different institutions with much different approaches. I'm doing asset-based lending, really focusing on the assets, and I don't like long-term contracts. You're doing purely long-term contracts, and you're doing working capital. So, non-bank lending, I think, has a lot of expertise where institutions can more appropriately price the higher level of risk. And then what we've seen in other industries is banks continue to be in the industry by taking the lowest level of risk and back levering the funds.
Just to complement, I think in terms of the biggest risk, obviously geopolitical being the key one. I would say in terms of the opportunities, what we're seeing is LNG bunkering as, again, a little bit of a thematic of LNG. There's a decent amount of buildup and the new projects that are coming up that could potentially be a good fit for us, given the long-term nature of the contracts, energy space, and kind of monopolistic positioning.
Thank you. Thank you to the 3 of you for your insights today, and thank you to Marine Money for having us.
Thank you.